Let me be brutally direct with you in the first 10 seconds of this video, because the financial media is not going to do it. Your broker is not going to do it. And your friends sitting around talking about crypto at dinner are absolutely not going to do it. The system that has kept the American dollar as the most powerful currency on the face of this earth for the last 50 years is fracturing in real time right now, today. And the overwhelming majority of Americans are completely, dangerously, almost criminally unaware of what that means for their savings, their investments, their retirement accounts, and their purchasing power. The UAE just walked out of OPEC. Saudi Arabia just sold oil to China in yuan. And meanwhile, you are sitting there wondering why your grocery bill keeps climbing. These events are connected. This is not a coincidence. This is a tectonic financial shift, and you need to understand it immediately, or you will pay for your ignorance with your wealth. Before I go any further, if you are not subscribed to this channel, you are making a financial mistake. The analysis I am about to give you would cost you thousands of dollars sitting across the desk from a private wealth advisor, and I am handing it to you for free. The only currency I accept in return is your subscription. Hit that button right now. Turn on the notifications, because the information I am distributing on this channel is the difference between people who built generational wealth and people who wonder what happened to their money. Subscribe now. Let us continue. To understand why the UAE leaving OPEC is a 5-alarm fire for the United States dollar, you need to go back to the architecture of the entire modern financial system. Because most people are operating with a completely incomplete picture of how money actually works. And incomplete information produces catastrophically bad financial decisions. Let me take you back to the year 1944, the tail end of World War II, when the Allied nations sat down at Bretton Woods, New Hampshire, and essentially redesigned the global financial order. The agreement they reached was elegant in its simplicity. The US dollar would be the world's reserve currency, and it would be directly convertible to gold at a fixed rate of $35 per ounce. Every other major currency on earth would then be pegged to the dollar. This meant that the dollar was not just paper. It was a paper claim on a physical, finite, real asset, gold. And because gold cannot be manufactured out of thin air, this system imposed genuine discipline on government spending. If you wanted to spend money you did not have, you had a problem because you could not conjure the gold to back the dollars you needed to print. That discipline was the entire point. Then came August 15, 1971, and a man named Richard Nixon made a decision that fundamentally and permanently altered the financial landscape of the entire planet. He suspended the convertibility of the US dollar into gold. He called it temporary. 55 years later, we are still living in that temporary arrangement. From that moment forward, the US dollar became what economists call a fiat currency, which is an academic way of saying it is backed by nothing except the collective belief of humanity that it has value. Read that sentence again slowly. The most powerful currency in the world, the currency your salary is paid in, the currency your retirement account is denominated in, is backed by belief. Not gold, not silver, not any physical asset that exists in finite supply belief. That is a profoundly fragile foundation for an entire global financial system. And the architects in Washington knew it. So 3 years later, and in 1974, they constructed a replacement architecture. They flew to Riyadh and they made a deal with Saudi Arabia that would become the invisible backbone of American economic power for the next half-century. The deal was simple, and it was brilliant. Saudi Arabia would price its oil exclusively in US dollars and would invest its surplus oil revenues into U.S. Treasury bonds. In exchange, the United States would provide Saudi Arabia with military protection and weapons. What this deal effectively accomplished was the transformation of the dollar from a gold-backed currency into an oil-backed currency, because every nation on earth needs oil to function. And if every nation needs to purchase oil in U.S. dollars, then every nation on earth must hold U.S. dollars in reserve. Demand for the dollar became structurally mandatory, not optional, not preferred, mandatory. That is the petrodollar system. And for nearly 50 years it operated in the background, quietly and ruthlessly, keeping the dollar enthroned as the undisputed king of global finance. Now here is where the story gets uncomfortable for Americans, because this is the part where the decisions made in Washington over the last several years begin to directly threaten the architecture I just described. The pandemic arrived in 2020, and the United States government did something that should have terrified every financially literate person watching. It opened the money printer, and it did not stop. Trillions of dollars were injected into the economy through stimulus checks, PPP loans, unemployment expansions, and corporate bailouts. The Federal Reserve's balance sheet exploded. Money supply metrics that economists track went nearly vertical. Now, I need you to understand the basic mathematical reality of what happens when a government dramatically increases the supply of a currency that is backed by nothing except belief. The value of each existing unit of that currency is diluted. This is not my opinion. This is arithmetic. You cannot increase the supply of something without diminishing the value of each individual unit, all else being equal. And in this case, all else was absolutely not equal, because the productive output of the economy was simultaneously collapsing due to lockdowns. So you had more dollars chasing fewer goods, which produced the inflation catastrophe that followed, and that Americans are still paying for every single time they go to a grocery store or fill up their gas tank. But the damage extended far beyond American borders. And this is the part that the financial media consistently fails to connect for you. Other countries around the world were watching the United States print money at a scale that had never been seen in peacetime, and they were making a rational calculation. If the country whose currency we hold as our primary reserve asset is going to debase that currency without apparent limit, perhaps we should begin diversifying into something else. Then in February of 2022, Russia invaded Ukraine, and the United States responded by doing something that sent shockwaves through every finance ministry and central bank on the planet. It froze Russia's dollar-denominated foreign exchange reserves. Approximately $300 billion in Russian assets were seized. Now, from an American political perspective, you can argue all day about whether that was the right decision, but I'm not here to talk about politics. I am here to talk about the financial consequences, and the financial consequences were immediate and severe. Every nation on earth that held significant dollar reserves looked at what happened to Russia and had the exact same thought. If the United States can freeze Russia's assets because Washington disapproves of Moscow's behavior, what guarantee do we have that our assets are safe? The dollar's value as a reserve currency is not just about purchasing power. It is about trust and security. And with that single policy decision, the United States introduced a question mark next to both of those attributes that had previously been considered absolute. Central banks from Beijing to Riyadh to New Delhi began accelerating conversations about alternatives to the dollar-denominated reserve system, and the pace of de-dollarization, which had been a slow, theoretical, academic discussion, became a concrete and urgent policy priority for a significant portion of the world's major economies. So now let us talk about what is happening today. Because the UAE's departure from OPEC is not an isolated event. It is the latest and most visible data point in a trend that has been building for years. And when you line up all the data points together, the picture they paint is alarming. Let me walk you through the timeline because the sequence matters enormously. In 2021, China launched its own crude oil futures contract, priced in Chinese yuan, on the Shanghai International Energy Exchange. This was a direct, deliberate challenge to the foundational premise of the petrodollar system, that global oil trade must be conducted in US dollars. China, the world's largest oil importer, was announcing its intention to buy oil in its own currency, removing the structural necessity for dollar demand that the petrodollar system created. Then in 2023, something happened that should have been front-page news across every financial publication in the world. Saudi Arabia, the very nation that in 1997 shook hands with Henry Kissinger and built the petrodollar system, conducted its first ever oil sale to China, denominated in Chinese yuan. The founding partner of the petrodollar broke ranks. That is not a minor footnote. That is a seismic event in the history of global finance. And now in 2026, the UAE, one of the largest oil producers in the world, has announced it is leaving OPEC entirely. The UAE has been one of the most vocal advocates for de-dollarization among Gulf nations. They have been actively working to conduct oil and commodity trade in local currencies with partners including India, China, and other emerging market nations. By leaving OPEC, the UAE is not just exiting an organization. It is declaring its intention to operate entirely on its own terms, outside the framework that has enforced petrodollar compliance for decades. And here is what you need to understand about the significance of that declaration. When a country the size of the UAE signals that it is comfortable trading oil outside the dollar system, it gives diplomatic cover and commercial confidence to every other producer that has been privately considering the same move, but has been reluctant to be first. The UAE just kicked the door open. Now look at the reserve currency data because numbers do not lie and feelings do not pay your bills. In the year 2001, 72% of all global foreign exchange reserves were held in US dollars. By the end of 2025, that figure had declined to approximately 56%. That is a 16 percentage point decline in global dollar reserves over roughly 25 years. That number sounds abstract until you translate it into what it actually means, which is that central banks around the world have been quietly and systematically, deliberately reducing their exposure to the US dollar and replacing it with other assets including gold, the Chinese yuan, the euro, and other reserve assets. The dollar is losing its grip on global finance, not in a dramatic sudden collapse, but in a slow, grinding structural erosion that most Americans are completely unaware of because it does not show up in their daily lives until suddenly one day it very much does. Let me now give you the mathematical reality that nobody in mainstream financial media has the courage to put in front of you plainly. Because understanding this mathematics is the difference between being positioned correctly for what is coming and being caught completely flat-footed. The dollar's status as the world's reserve currency is not a binary condition. It does not flip from 100% to zero overnight. What it does is erode along a curve, and at certain inflection points along that curve, the consequences for Americans become qualitatively different and dramatically more severe. We went from 72% to 56% over 25 years. That is a decline rate of roughly 0.6 of a percentage point per year on average. But de-dollarization is not a linear process. It accelerates as more countries see others moving away from the dollar and decide to do the same, creating a reinforcing feedback loop. If we apply even a modest acceleration to that trend and assume the rate of decline doubles to 1.5 percentage points per year, which is entirely plausible given the current geopolitical environment, we could be looking at global dollar reserves dropping below 45% within a decade, below 40% within 15 years. At 40%, the United States loses a structural benefit it has enjoyed for 80 years, the ability to run persistent trade deficits without facing the currency crisis that would destroy any other nation attempting the same thing. Every other country on earth that has tried to spend significantly more than it produces has eventually faced a currency crisis, a sovereign debt crisis, or both. The United States has been exempted from that iron law of economics for 80 years because the world needs dollars to buy oil and to settle international trade. Remove that exemption even partially, and the United States faces the same arithmetic as everyone else. And the United States government right now is running a deficit of approximately $2 trillion per year. $2 trillion per year if the world's appetite for U.S. treasuries, which the government uses to finance those deficits, decreases, because those countries need fewer dollars because they are buying oil in yuan. The United States has to either cut spending dramatically, raise taxes dramatically, or print money at a rate that makes the pandemic era look restrained. Every single one of those auctions has severe consequences for the American economy, for American purchasing power, and for the value of every dollar sitting in your savings account, your brokerage account, and your retirement fund right now. This is not a theoretical future problem. The conditions that produce this outcome are being constructed today. And the UAE walking out of OPEC is one more brick in that construction. Now, I refuse to be the general who only describes the battlefield without giving his soldiers a plan for how to fight on it. So let me be very specific about how a rational, disciplined investor should be thinking about positioning in this environment. Understand that I am not your financial advisor. I am not giving you personalized investment advice. And any investment involves real risk, including the risk of losing everything you put in. What I am giving you is a framework, a way of thinking like someone who has navigated multiple currency crises, multiple geopolitical inflection points, and multiple periods of structural economic transition. Use it as a starting point for your own due diligence. The first position to understand is gold. I want to be precise here because too many people either dismiss gold entirely or treat it like a get-rich-quick vehicle. And both of those approaches are wrong. Gold is not an investment in the traditional sense. Gold does not produce earnings. Gold does not pay a dividend. Gold does not grow its revenue. Gold is a monetary asset. It is the 5,000-year-old alternative to fiat currency. And its price relative to the dollar rises when confidence in the dollar's purchasing power falls. We have seen gold prices move dramatically over the past several years, precisely because central banks around the world, the same central banks that are reducing their dollar reserve allocations, have been simultaneously increasing their gold holdings. China, Russia, Turkey, India, and dozens of other central banks have been net buyers of gold at a historic pace. When central banks, the most sophisticated institutional actors in global finance, are collectively moving from dollars to gold, that is a signal worth paying serious attention to for individuals who want exposure to gold without taking physical delivery. Exchange products that track the gold price provide accessible market exposure. But understand what you are owning. A hedge against dollar debasement, not a growth investment. The second position is international equity diversification. The thesis here is straightforward. If countries around the world are working to strengthen their own currencies and build their own economic independence from the dollar system, their domestic economies and stock markets stand to benefit from that process. Emerging market economies in particular, many of which are resource-rich and are actively building new trade relationships denominated in their own currencies, have significant growth potential that is not captured by a portfolio concentrated entirely in U.S. equities. Broad international equity exposure through diversified funds, covering both developed international markets and emerging markets, gives you participation in global economic growth that is increasingly decoupled from U.S. dollar dynamics. The risk is higher than a pure domestic allocation. The potential return is also higher. Sizing this position appropriately relative to your overall risk tolerance is your responsibility, not mine. The third position is domestic energy. This is counterintuitive to some people, but think through the logic carefully. If the petrodollar system is fracturing, and the United States can no longer rely on its geopolitical relationships to guarantee favorable oil pricing and supply arrangements, the strategic imperative for American energy independence becomes overwhelming. That imperative translates into massive capital flows into domestic oil and gas production, domestic refining capacity, and domestic energy infrastructure. The companies that operate in that space, the large integrated oil majors, the pipeline operators, the refiners, are positioned to benefit substantially from that capital allocation. Domestic energy sector exposure through broad sector funds gives you participation in that theme without requiring you to pick individual winners in what is a complex and capital-intensive industry. The fourth position is defense and aerospace. I recognize that some people are uncomfortable with this one on moral grounds, and I am going to acknowledge that discomfort and then set it aside because we are talking about financial reality, not moral philosophy. The geopolitical fragmentation that is driving de-dollarization is simultaneously driving increased defense spending across virtually every major economy on Earth. When alliances fracture, when trade relationships are restructured along geopolitical lines, when regional conflicts proliferate, governments spend more money on military capability. That is a historical fact going back centuries. The companies that manufacture the equipment, the systems, the platforms, and the technology that governments buy when they increase defense spending are direct beneficiaries of that dynamic. Defense sector exposure is a rational hedge in a world of increasing geopolitical risk. And the current environment is as geopolitically volatile as any we have seen since the Cold War. The fifth and final position is the U.S. domestic economy itself, because I want to be absolutely unambiguous about something. I am not predicting the collapse of the United States. I am not predicting the imminent death of the dollar. What I am saying is that the structural advantages the dollar has enjoyed for 80 years are being gradually eroded, and that erosion will have real consequences that irrational investors should be prepared for. But the United States remains the world's largest economy, the world's most innovative economy, and the home of the world's deepest and most liquid capital markets. American companies generate real earnings, real cash flows, and real value regardless of what happens to the dollar's reserve currency status in the short to medium term. Broad exposure to the 500 largest companies in the U.S. equity market gives you participation in American economic growth, while also giving you exposure to companies that generate a substantial portion of their revenues internationally, providing a natural hedge against dollar weakness through their foreign currency earnings, and diversified allocation across all 5 of these themes sized appropriately to your individual risk tolerance and time horizon, positions you to navigate the transition that is underway, rather than being blindsided by it. Let me leave you with this, and I want every single word to land with the weight it deserves. The petrodollar system was not built in a day. It was built over years of deliberate geopolitical maneuvering, and it is not going to collapse in a day either. But it is being dismantled piece by piece, deal by deal, country by country. It is a chapter in a book that has already been written, and the final chapter of that book is a world where the US dollar commands significantly less automatic global demand than it does today. You now have two choices. You can close this video, go back to whatever you were doing, and trust that somehow the financial consequences of this structural shift will not touch your life, your savings, or your family's financial security. Or you can take this information seriously. Begin educating yourself with the seriousness and urgency this moment demands. Do your own research. Consult a qualified financial professional and make deliberate, informed decisions about how your portfolio is positioned for the world that is coming, rather than the world that existed 50 years ago. One of those choices is the choice of someone who will look back in 10 years and say they saw it coming and they acted. The other is the choice of someone who will look back and say they knew and did nothing. I have given you the intelligence. What you do with it is entirely up to